It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Something historic in the markets are happening right now as we speak. And I'm going to share this with you because I want you to be aware. To ignore this is to your own peril, especially financially, especially if you're invested. And by sharing this information, my hope is you're going to be able to make better decisions for yourself going forward. Now, what is happening historic? What is so significant? It's the valuations of the market. We've been discussing this for a while, but we have now hit levels never seen before in history. I'm talking about going back well over 100 years in the markets, the stock market. We have not seen valuations like this. And almost no matter how you measure it, the same thing keeps coming up. We have three periods in the last 125 years where we've seen similar type of scenarios. The first time was in 1929. The next time was in 1999, the dot-com bubble, and currently. Now, even the most casual investor knows what happened after 1929 and 1999 was not good in the economy or the markets or the valuation of stocks for that matter. Will history repeat itself again this time? That's the big unknown. But certainly what is known is risk is highly, highly elevated to extreme levels that we have, in some respects, never seen before. Let me explain further. There's a chart, for example, that came out recently from Bloomberg that measures combined trailing PE, forward PE, those are price earning ratios, market cap to GDP, and a few other factors, and it puts them all together. It's a valuation measurement. And again, it's hit all-time new highs going all the way back to the 1880s. The last time the markets hit similar numbers, again, was 1929, 1966, and 1999, and again today, which we have surpassed the highest levels ever recorded, which occurred previously in 1929, right before the Great Depression. Another measurement is the S&P 500 price to peak earnings ratio. It is at its highest levels since 2000 and over 50% over the historical average. In fact, the S&P 500 is now trading at over 3.2 times sales, which is the highest valuation in history ever recorded. This means that stocks are trading at 3.2 times more price than the valuation of their sales or the value of the company. Another popular measurement is this Shiller PE, which measures stock prices against 10 years of average earnings. In other words, it averages out the earnings over a decade. Kind of tends to smooth things out a little bit. And when the Shiller PE ratio hits around 25 to 30, it's considered pricey. Currently, we're at 38, which happens to be one of the highest times ever recorded. Again, the only other time previous. We saw it briefly in 2000, but we're significantly higher than even 1929. The measurement in 1929, by the way, was 30. Today it's 38. So it's 20% higher than even 1929. Euphoria has taken over the markets is really what's happened. Bloomberg has another measurement called the Intelligent Market Pulse Index, and this measures 6 metrics like market breadth, volatility, and leverage. It's a market sentiment measurement, and it's hit exuberance levels. Exuberance in the market is over is through the roof. Irrational exuberance. You remember that? Some of you have been around long enough know that in the before the dot-com crash, we had a Federal Reserve chairman, I think it was Alan Greenspan, who was bandying about irrational exuberance, I think was the term. Well, that's what this measurement is doing. It's sharing exuberance at levels we haven't seen since 2000 or even 1929. In fact, even higher today than then. And this is a statistic that most people are not aware of that are investing. It turns out that the world owns over 25 trillion of U.S. assets, more than Americans own abroad. In fact, the international investment position has doubled in the past 5 years. This is part of the reason why our markets have increased so substantially. If people and governments and wealth funds and etc. international start to pull back on their U.S. positions, this could create a significant risk to investors that many are not aware of. Another measurement that's interesting to look at this a little closer, the ratio of U.S. large caps to small caps is at the highest level since the dot-com era. In fact, we're over 3 times the historic average. In other words, the large caps are flying, the small caps are not. The NASDAQ, in fact, has now hit all-time high levels. The market cap of the NASDAQ is now 105% of U.S. GDP, which is the first time it's ever hit this level. That happens to be 60% higher than the peak from 2000 dot-com bubble. And the S&P 500 information technology sector price relative to the regular S&P 500 has also hit a new high, all-time high, about 20% higher than the dot-com bubble. Starting to see a pattern, aren't you? The dot-com and 1929 periods were historic levels of valuations in the stock market, and we are now at or above those levels, regardless of how you measure valuations. This is historic. This is a bubble that is skyrocketing. But it gets even more concerning, and this is what I mean. The top 10% of U.S. stocks reflect 76% of the U.S. equity market. The entire market is the valuation of the top 10% accounts for 76% of the total value, which is, again, the highest level ever recorded, even surpassing the level that was set in 1929. We're witnessing history. This is historic risk. And I don't have to remind you what happened after 1929. The top 10 stocks actually account for a record 40% of the S&P 500's market cap. Again, another all-time record by far, about double the peak of the dot-com bubble. Again, enhancing risk by having a concentration of just literally a couple handful of stocks driving this historic market valuation. It even gets uglier when you dig further. It turns out that the other 490 companies in the S&P 500 have basically had no earnings growth since 2022, despite inflation. In fact, the other 490 companies in the S&P 500 have actually contracted in real terms when you add in inflation levels, while the top 10 companies have increased and grown significantly, in fact, nearly doubling their growth and their valuations in that same time frame. They're pulling away from the pack. It turns out NVIDIA and Microsoft now account for 15% of the S&P 500's total market cap, which is an all-time high. Never in the history of financial markets have two companies, certainly not in the modern era, where two companies have had such a large share of the U.S. stock market. The market concentration is insane. It's at levels, historic levels, that have never been seen. Why is this all such a concern? Much of this driving upside growth that we've seen in the markets and the market valuations, driven by literally 10 companies and primarily by 2. The reason why it's so significant and enhances risk, elevates risk to historic levels that we have not ever seen before, including periods of time like 1999 and 1929. One or both of those companies, or a couple of those 10 companies, stumble for whatever reason. Something goes wrong, anything. And to make matters worse, they're all in the same sector. They're all tech stocks. So if something happens to that sector, we are going to see a correction, probably a historic correction, unlike anything we've ever seen. When you have a historic bubble, that increases the likelihood and the risk of a historic correction. Here's another way to understand this. If someone were to recommend to you, for example, to purchase or invest all of your money in 1 or 2 companies, typically what would the response be? For most people, it'd be, you're crazy. Why would your entire retirement, everything you have, put it in 1 or 2 companies? Your response, most people, would be, you're crazy. And the reason why is simple. You wouldn't want to put all your eggs in one basket. There's no diversification. Why would you put everything? It's like going to Vegas, put everything on one number on the roulette wheel. If it comes out, great. Yes, you can win fantastically. But if it doesn't, you can also lose spectacularly. So if you wouldn't go put all your money in just 1 or 2 or even a handful of companies, why are you doing it? By the way, many people that are listening to me right now as we speak are doing exactly that. And many of you are unwittingly doing so. Why do I say that? Well, many mutual funds, index funds, etc., are invested in baskets of stocks, or S&P500 index funds, for example. Many funds overlap in terms of what they invest in, and many of them have invested heavily in these tech stocks because of the historic run-up in their values, which means a significant volume or amount of your investments portfolio is probably tied up in these handful of stocks. Most of your growth over the last few years, if you've had significant growth, have come from those stocks, most likely. If you weren't in those stocks, your growth has not been that significant. You are not diversified, most people listening right now, at historic levels, which creates historic levels of risk. And the previous times we've seen this happen, 2 times previously, again, 1929 and 1999, the results thereafter were horrendous. My suggestion is look at your portfolio. Actually see how much of your portfolio is invested in these handful of stocks. And wouldn't it be prudent, after a all-time historic run-up in valuations, at least pull some of the winnings off the table? Certainly could go up from here, but it definitely has the potential of going down too, and significantly. Why risk it? If you've had historic gains, I know it's human nature. It's hard to pull out when things have been going, euphoria sets in, as I stated earlier. It's a basic human nature. But the prudent, wise investor takes winnings off the table. If you don't believe me, follow Warren Buffett's example. Considered one of the best investors in history. He's on the sidelines. He's taken his winnings off the table, and he's waiting for the next correction. In the meantime, instead of just sitting in cash, you could use your personal bank, for example, to earn 6% plus insured, guaranteed, tax-free, and highly liquid. And then you can access those monies when the correction occurs and re-engage. We are at historic levels of valuations, all time, ever recorded in the history of the stock market, which means we're also at all-time historic levels of risk, considering pulling back on some of that risk. If you want more information, contact me at yourpersonalbank.com. I can show you how to do that most effectively. Now stay tuned in the next segment. I'm going to give you some reasons why this run may continue for a while before it pulls back, or maybe while it won't.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. As I was stating in the first segment, valuations in the stock market are at historic levels. They've never been recorded this high. It's euphoria beyond anything we've ever seen, including periods like 1929 or 1999. Now, many people are predicting that we will see a significant market correction or even a crash because of the overvaluations. Historically, that definitely is true. We saw that the last two times. It didn't go well after 1929 or 1999. It was brutal in both cases. We're higher levels than even those points. And if the AI hype, which is what's driving this, fades or earnings miss or something else happens, we could hit the ground really, really hard. In fact, another measurement that I've shared on this show many times is called the Buffett indicator, which measures the total value of the stock market to GDP, has just hit its highest level ever in history. It's at 212, which is more than double its average value. Again, we're witnessing history here. This is stuff we've never seen before. The warning signs are everywhere. And I like what this one person posted. Well, now we're just waiting for the catalyst so that the market strategists can claim, black swan, no one could see this coming. What I'm trying to say is you just weren't paying attention. It's quite obvious if something negative happens, or even mildly negative happens, like an earnings miss or something like that with one of these top 10 companies, for example, because they're all in the same sector. They're all in the tech sector. If one of them struggles or stumbles or something negative happens, that could create a cascading event. Or the AI, I've shared this before. Hey, I believe AI coming forward is going to be a big thing. But the reality is, it may take longer to implement and make the economic difference that the projections are telling us, or where the hype is at. We saw the same thing in the dot-com era. It was projected that the internet was going to fundamentally change the economy. And ultimately it did. But frankly, it took a decade or more longer than what the projections were back in the late 1990s. It turns out it takes human beings a while to adjust to new technology. Certainly there's some early adopters. There always are. But what I'm trying to say is the majority of people, that tipping point where the majority are using the technology versus not, where it becomes economically viable and then productive and then builds the economy, human behavior is hard to measure. And many of these Silicon Valley tech bros, whatever you want to call them, they're young, they're ambitious, they're smart, they want to raise money, they want to tell a great story. They're the innovators, the creators. They adapt to this stuff quickly. They're some of the first adopters many times. And they struggle oftentimes to understand the average person who doesn't have that knowledge or desire to adapt or use this technology in the way that they're doing, or way they're visionaries in many cases. And visionaries see things early oftentimes. I don't know what's going to happen. No one really does. But there certainly is the potential for there to be some discouragement or disappointment or delays or stumbles by any one or more of these companies going forward that could then cause a significant correction because we've seen such a significant increase. Why would this time be different? Perhaps, for example, a valid point is, unlike the dot-com run-up, where many of those were profitless startups, the Magnificent Seven are cash machines. Microsoft, for example, made $76 billion last quarter. So it is true that these companies are making significant amount of money. Earnings momentum is very strong, which can justify these historic valuations. But here again is where one of my concerns come into play. AMD, for example, reported $872 million in net income in their most recent earnings But the number was almost entirely artificial when you dig into it. It was padded by over 800 million one-time tax reserve release and another 100 million gained from discontinued operations. If you strip those two things out, the company posted a loss. Now, AMD is one of the big tech companies. It's not one of the Magnificent Seven, but it's a big one. Management was touting strong cash flow, but deeper look into it reveals the cash came from selling off future revenues. This is getting ugly if you look into this further. So their future revenues will be diminished. So they can post a great number now, make it look good, but down the road, it's not going to be as pretty. They also, AMD, delayed $836 million in payments to vendors, which inflated the optics of their free cash flow, which distorts the true value or health of the business. It creates an illusion of strength while masking underlying weakness. Now, I haven't had time to dig into some of the earnings of many of these other companies, but AMD is a perfect example of trying to keep up with the Joneses. And this is where I think there could be a dangerous precedent being set here. There's so much pressure for earnings for these companies that are leading the charge for these other companies around it to keep up, because any negative or perception of negative is going to hammer their stock price. Because again, we're at historic high levels. A poor earnings number comes out. These companies are going to pull all the stops like AMD did to try to keep the music going, if you know what I'm trying to say. But eventually, unless they can earn a bunch of money in the near future, they're going to pay the piper. And if there are other companies that are doing similar things like AMD, that can cause a major concern regarding the bubble of the semis and the AI hype, because are they really making the money they're purporting or on their earnings call to be making, or are they doing some accounting tricks like AMD has done to make it look like they're profitable and strong cash flow when in reality they're not? So we'll see what happens, but I want you to be aware of this. An educated investor needs to know these kind of things to make educated decisions. You can't just go along with the hype. And my suggestion has been all along, if you want to take advantage of the potential continued run-up, which many of these bubbles can run far higher, far longer than many people, or what logically makes sense, because it's emotion-driven, it's greed-driven. Wall Street runs on fear and greed. We all know that. So there could be some significant upside from this point still, this before the bubble bursts. The bubble's going to burst at some point. I think that's just realistic. But if you want to take advantage of some of that, but yet shield some of your potential downside risk, why not take some of the winnings off the table? I mean, that's just the smart, prudent move. That's the intelligent move. You don't have to ride that roller coaster is what I'm trying to say. This is the golden age of fixed assets. Annuities have been paying best returns, best rates I've ever seen in my 25-year career, and they're the best in the 40 plus years. I mean, I've got clients, I'm doing reviews right now. It's incredible. They're getting 20 and 22% returns on their annuities. And the beauty is those are then locked in. So if the market does correct next year or at some point in the future, the gains they receive, they get to keep. That's powerful. Also, the one negative of annuities that people have is you have limited access. 10% per year typically is what you can receive, but annuities with market value adjustments, I did another one today where the market value adjustment, because it's so much the annuity is so much more profitable than the older ones, I'm saying ones at 2-3 years old, they're actually almost 100% liquid after 1 year. If they literally closed the account and walked away, they would get them all the money they put in after a year. I'm seeing this over and over and over again. And they got about a 20% return on their money this past year. Incredible. They couldn't be happier because, again, they get to keep it regardless of what happens in the future. You can't say that about the markets. I'm just saying, voice of common sense, voice of prudence. If you've won, if you've been winning, don't continue to expose yourself to that level, historic level of risk. We're at historic valuation levels. all-time highs, including 1929 and 1999, higher than that even. So this is the highest risk environment we've ever seen in the markets. That's a good time where, the old adage, buy low, sell high. Maybe you should take some winnings off the table, put it into something that certainly could grab some more upside, but if it goes down, you don't lose. It's that simple. Contact me at yourpersonalbank.com for more information. And I've got some information regarding some more reasons why, although there certainly is reason for optimism with the markets going forward, there's also some concerns, and a lot of it has to do with the federal debt.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So in the first couple segments today, I've been really sharing the historic valuations that we're experiencing right now in the markets. These are the highest levels we've ever seen ever in history. This goes back over 125 years. It includes we're at higher levels of valuations of stocks than we were in 1929 or 1999. We're in historic times. With historic levels of valuation also encompasses historic levels of risk. If risk concerns you a little bit, this is the highest levels it's ever been. Highest levels risk has ever been. May want to consider reallocating. It's the golden era of fixed assets. We've never seen numbers as good as we've seen. Tremendous upside potential. I've been doing reviews and folks getting 20% returns this past year or two. It's been awesome, but the best part, they're locked in. If markets go down in the future, they don't lose. That becomes their new principle. It's powerful, unlimited upside. We've never seen products like this. Well, not in my career, 25 years, and not certainly in the last 40 years, actually. This is incredible. Again, the golden era. Peel off some of the winnings. Continue to go up and grow if it does well, and if it doesn't, you don't lose. That's a pretty good position to be in, at least with some of your money. Now, here's another reason why the markets may not continue to keep just screaming up to the upside. We have a reckoning coming, but a lot of it has to do with the federal debt and the bond market. These are things that cannot be ignored forever. So far, the stock market has, for the most part, managed to ignore this, but eventually they're not going to. Here's why. U.S. debt has officially crossed the $37 trillion mark for the first time in history. In fact, U.S. debt increased by $780 billion since July of this year. We're increasing an average of $22 billion per day of debt. And the past week alone, the U.S. government sold $724 billion in treasuries through 10 auctions. These, again, are also historic numbers that we have never seen. In fact, in July of 2025, the U.S. Treasury spent 25%, or 1 in 4 of every tax dollars received, just on interest payments alone. No new projects, no benefits, just interest. When 25% of your budget, or your income, is being spent on interest, you've got a debt problem. That's a lot of debt to be going out of your total income. Now, you can manage it. We're still in manageable territory, but we're getting close to critical territory. In fact, this quarter, the U.S. needs to borrow another $1.5 trillion just to keep up with the spending. And we've already spent $1 trillion in interest year to date. So we're looking at about $2.5 trillion of interest just this year. And every 1% rise in interest rates or yield, bond yields, equals hundreds of billions of dollars in interest payments, which means more debt. This means more auctions. It means higher interest rates, as the Federal Reserve has been saying, higher for longer. Now, folks, long-term higher interest rates are extraordinarily bad for the stock market. Real estate markets too, by the way. We'll get into that further. But it turns out I was watching the most recent bond auctions. This past week, the U.S. Treasury sold off $25 billion of 30-year bonds, and the yield they paid were 4.8%. Now, why that is so significant is that's one of the highest yields on record in a very long time. They had to increase the level or the interest they were offering just to get the bond buyers to purchase. This is something I've been discussing on this show quite some time, and again, something that cannot be ignored. Higher bond yields means higher interest rates, which affects everything. Higher cost of money. If you're borrowing money for an auto loan or a mortgage, or a business wants a business loan, they have to pay higher interest rates, which means higher cost of money, more expensive to expand, grow, build, lower profits. Also, not only is the U.S. government spending a ton on interest, so are U.S. consumers. If they're paying more of their income in interest on debt, they have less money to purchase. The consumer is struggling. Now, all this AI and investments in these companies growing do require consumers to purchase stuff. This will all come home to roost eventually. I don't know what time frame, but this will all come about, and it can't be ignored forever. Again, if we look at the Treasury market, it's a signal that the foundation of demand, particularly the longer end of the curve, is weakening. In the past week, like I said, the 10-year and 30-year auctions met historically low levels of demand. They had to offer higher levels of interest to get the buyers to buy. The institutional investors are more cautious than ever. This is going to cause long-term economic challenges to the profits of companies that sell stuff, make products to people. Now, it does create an opportunity. Again, it's the golden era of fixed assets. If you're investing on the fixed asset side, like annuities, high cash value insurance, things like that, you're going to get a higher return. I mean, you even see it in the bank. I often say, it wasn't that long ago that you couldn't get 1% at a bank, could you? You couldn't get a CD, even a 5-year CD at 1%. That was only about 3 years ago, by the way. Today, people are getting 4 and 5% even. Well, if you think about that, that is a 4-fold or even 5-fold increase, 400 or 500% increase from just 3 years ago. Now, again, if you're on the investment side, that's great. You're getting a better return. And by the way, safely, oftentimes insured, guaranteed even. With high cash value policies and annuities, these are guaranteed assets. These are things that grow no matter what. That's awesome. Dividends, no matter what. But it's detrimental long-term economically to companies, which affects stock prices. Like I said, these past 10 auctions that we had, that the U.S. government had, were rather rough. And the ugly portion of it was the longer term ones, because they had, for the government that is, because they had to offer higher interest rates to get these bond buyers to purchase. Now, again, if you're on the purchase side, you take an insurance company. This is why, again, why so many of these insurance companies are making so much more money, so much more profitable than they were even a few years ago. Why it's the golden era of fixed assets. For example, I spoke to the CFO of one of the major insurance companies about a year ago, and he stated to me, he goes, Ferretz, a couple of years ago, we were buying 30-year treasuries getting 2%. And at that time, he said, now we're getting 4.5%. And the last auction, they just got 4.8%. Well, if you were getting 2% and now you're getting 4.8%, you have increased your profitability on that investment by almost 2.5 times, almost 250% increase. That's incredible. That's a massive, massive increase in profitability. So again, what's bad for one party is good for the other. It just depends on what side of the coin are you on this, all right? This most recent treasury auction was so bad For example, they were selling just under $100 billion of bonds. They raised the interest rate off to 4.8% on the 30-year Treasury, for example, which is near high levels we've seen in a long time. But it was so bad that the Federal Reserve had to step in and buy 14 billion of it because there just wasn't anyone that was willing to buy them, even at 4.8%. It's close to the level that's considered detrimental to the stock market in terms of investors, particularly institutional investors, where rule of thumb, if they can get 5% on a treasury, they'll tend to invest more of their money into the bonds versus the stock market. And the reason's simple. Let's say you're a pension fund and you have pension obligations. You got to pay out so much in benefits each month to your beneficiaries. Is if you can get a 5% return, you can satisfy the obligations, your pension obligations. Well, if you can get 5% in a treasury, which is essentially almost guaranteed, versus investing in the market, potentially making more, but certainly potentially making less, again, at risk, they're going to take that in a heartbeat because they've set aside their pension obligations. And if they're doing this in, say, a 30-year treasury, they've just locked that in for that bucket of money for the next 30 years. I mean, that's sweet for those kinds of institutional investors. Why is that so important? They're the biggest investors out there. Institutional investors, on average, own about 88% of all stocks. Let's say half of those people, not all of them are in that boat. Let's say half of those institutional investors are in the position where if they can get a strong enough return in the bond market, there's no reason for them to invest in the stock market. What do you think is going to happen to the valuation of the stock market if a third or half of the institutional investors exit? These are big money, big dollars. These are things to be aware of. The bottom line point I'm trying to make is this. Equity markets, like the stock market, care a lot about vibes or feelings or emotions. We get euphoria, like we're seeing now, fear and greed. Those markets really are driven by fear and greed. The true value of a stock is the value of what someone else is willing to pay for it. That's the bottom line. And a lot of that has to do with emotion, human emotion. Bond markets are far different. These are institutional investors. You have to be a big player typically to be investing in a treasury auction, for example. These are professionals. This is what they do for a living. This is their job. They care about fundamentals. They don't care about emotion. And when the fundamentals get loud enough, they'll drown out the vibes, the emotion. And if the stock market, which so far has been pretty much ignoring the bond market, if they don't listen, eventually something will break. And like what's most likely is going to happen, which one's going to break? Well, you realize the bond market is many times larger than the stock market. Again, that's something most people are not aware of. The bond market is far larger than the overall stock market. Many fold times. That's again why it's known as the big money, or they call it the smart money. That's where the big money is. And that's what drives the market most of the time. Again, emotions of fear and greed sometimes can override that for a while. And sometimes longer than you even realize or think's rational. But, vibes can do that, right? But eventually, fundamentals matter. And eventually the bond market wins out. My suggestion, don't ignore this. We're at all-time historic levels of valuation in the stock market, which means we're at all-time high levels of risk in the stock market. If you're invested, if you're at risk, my recommendation is simple. Pull back on that risk. It's not me just saying that. Listen to people like Warren Buffett who are doing exactly the same thing. Pull some of the winnings off the table. Put it into something that's guaranteed. Hey, if it continues to grow and go up, I've got unlimited upside annuities that markets go up 10, 20% again next year. Great. You can take advantage of that and you'll get that, like many of my clients have received in the past couple of years. But when it goes down, your principal is guaranteed and you don't lose. And I can show you assets that are guaranteed that are highly liquid. So it takes away that limitation that many people think exists with fixed assets. It's the golden era of fixed assets for a reason. Stay tuned last segment. I got a few more things about the consumer that I think you'll find very interesting. Don't miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. So we've been discussing the historic valuations of the stock market, all-time highs. We have literally never seen anything like this. This is history defining, folks. We're seeing the highest levels of valuations in stocks since even before levels like 1929, before the Great Depression, or levels of 1999, right before the dot-com bubble and then burst. We've never seen, and we're seeing levels higher than that even. All-time valuations equals all-time high risk, because the risk to the downside is now elevated. The higher you go, the farther it can fall if something goes wrong. The euphoria, the sentiment, the vibe, the AI hype, all the things we're seeing and experiencing can continue further. It could run up from here further yet, but there will be something there'll be something that'll cause this to break. No one knows what that may be. No one knows what that catalyst is, but there will be one. And when that catalyst occurs, because it's so high, historically so, we could also then see a historic downturn just as dramatic, much like we saw in 1929, which the high to lows of that were, by the way, about 90%. We could see something like 1999, where the NASDAQ top to bottom dropped 72% in about a 2-year period. Folks, it was ugly. I was there. I was in this business. And the beauty of all this is I would do reviews then, and my clients would say, how in the world did everyone I know has lost 20, 30, 40% this past year, and yet I still have all my money. It's because we had them in annuities and cash value life and assets that were guaranteed. They would go up in good years. We have many products that have unlimited upside. I got folks that made 20% plus in the past couple of years in their annuities. But here's the beauty of it. If the market does correct, or when it does, I should say, they get to keep it. They get to keep those gains because they lock in each year. Also, I can show you products where the liquidity is amazing. Far more than anything you think or ever have seen, because the products are that much better now than they were even a couple, 3 years ago. And with market value adjustments, I even have annuities where clients have been, their surrender fee to get out early, which is the one limitation of annuities, is eliminated in the first year. In other words, they could close their accounts, walk away with more money than they put in a year ago. Now, they're not doing that for obvious reasons, because they made 10, 15, 20% last year, and they locked it in, and they're pretty darn happy. But if they wanted to, they sure could, which takes away the one limitation annuities have. So if you've got a good product that gets that's profitable, getting good gains with a strong MVA, market value adjustment, I'm seeing people being fully liquid in their annuities within a year or two. This is amazing. It's the best I've seen in my 25-year career. It's the golden era of fixed assets. I can't say that enough. I'm just having fun. I'm showing people stuff they've never seen before. It's incredible. So if you haven't looked at an annuity the last couple, 3 years, or you have one, by all means, it's time to look at it. You can contact me at yourpersonalbank.com. I can show you how you can reduce your risk, maybe take some of the winnings off the table if you have that, and really benefit going forward. Hey, keep grabbing upside if it happens going forward. If this historic run continues, great. You get to continue to take advantage of it. But whenever that music stops, whenever the situation changes, whenever the catalyst, whatever that's going to be happens, and it will, you won't have to you won't have to partake in that. You won't be involved. Your principal is guaranteed. You locked in. Now, another reason why I'm concerned, what could be the catalyst ultimately, is the U.S. consumer. Yes, the federal government has a lot of debt. That's a big problem. Bond yields are historically high and will likely continue because the federal government's selling so many bonds, which is pushing bond yields or interest higher, which means, as the Federal Reserve has said, higher for longer, which is generally bad for the stock markets and real estate markets for that matter. But ultimately, it comes down to the U.S. consumer because about 2/3 of U.S. GDP is consumers. Well, it turns out U.S. debt has now jumped to $185 billion, a new all-time record. All types of debt have increased. Credit card debt, for example, have also hit new all-time highs. But to go further into this, is U.S. consumers that are in serious delinquency, that's considered 90 days or longer, have jumped all types of delinquencies. Mortgages, auto loans, student loans have all materially jumped to the highest levels we've seen since the 08-09 financial crisis. So again, this is another area where we're starting to see historic levels of debt with the consumer and historic levels of delinquency, serious delinquency on that debt. They're having serious financial problems. Generational level of inflation didn't help them any. The credit card debt in particular, which has now hit a new all-time level of $1.2 trillion, has risen by over $440 billion or 57% over the last 4.5 years. That is the greatest increase in credit card debt ever recorded and the highest levels of credit card debt ever recorded. On top of that, to make matters worse, interest rates are higher than average, including on credit card debt, which tends to be very expensive credit, double-digit interest. People that are using their credit cards to bridge the gap or trying to maintain their lifestyle or whatever purpose they're using it for, this is a short-term solution. This is a debt crisis that will crash. This is causing U.S. consumers' overall personal expenditures or U.S. consumer spending at the same time has been dropping rapidly. Now, again, if 2/3 of your economy is slowing down significantly, like we're now already at levels we haven't seen. The only levels we've seen below this, by the way, were in the 08-09 financial crisis. It's the worst it's been since then. It hasn't stopped dropping. We're not sure where it's going to stop yet. This will cause serious economic damage and will impact stock prices, and not in a good way. As someone who talks to folks about financial matters, literally coast to coast, I'm blessed. This radio show goes out across the country. We're in over 20 radio stations across the country. Love all the listeners, the people that reach out to me. Thank you. I enjoy it. It's an honor. But I also have a unique perspective by dealing and talking to these people about their personal money, their financial situation, their goals, what they're trying to accomplish. And I can tell you from firsthand experience, there's a lot of folks out there that are struggling. Now, there is some reason for hope. I don't want people to get too despaired, because as Treasury Secretary Scott Bessent stated recently, Wall Street's had its run. Now it's Main Street's turn. He even said, forget the S&P 500. That's the U.S. Treasury Secretary. And even Goldman Sachs has come out and agreed that median income, manufacturing growth, and real wages are the things that will be on the rise in the future. He used an example of some Ohio steel plants paying 18% more now than they were just a few months ago just to fill jobs. There's an economic revival I believe we're in the very, very beginning of, with manufacturing, blue-collar work, increased wages. So there's reason for hope, but it will take time. This is a transition that's not going to occur overnight. At some point, this historic run up is going to hit a snag and it's going to correct. And I hope this is not true, but it could correct hard and fast and significant, and it's going to hurt a lot of people. I would prefer you be one of those people that got out of the way, or at least got some of your money out of the way. I hope you're going to be one of those people and listen to a voice of reason, common sense, and recognize you don't have to ride the roller coaster up and then back down again. You can get off the ride. You can still ride it, continue to ride it up if it goes further, but protect the downside if and when the inevitable happens and it corrects. Contact me at yourpersonalbank.com for more information. Listen to the Your Personal Bank show next week for more great info, and as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.